Everyone, and welcome to our season 5 of the EDHEC Speaker Series. I'm Emmanuel Jurczenko. I'm the Executive Director of the Graduate Finance Program, and it's my pleasure, as usual, to introduce you for today's session speaker. I'm delighted to welcome Professor Lasse Pedersen. So Lasse is a professor of finance at Copenhagen Business Schools. Well, he's well known in terms of his research. He worked on so many different topics: asset pricing, financial machine learning, responsible investing, low risk investing, dynamic portfolio selection. I will stop liquidity risk just to stop. His work has appeared in leading journals: Journal of Finance, Journal of Financial Economics, Review of Financial Studies. So today, Lasse will talk a super interesting topic about how to measure greenium. He will propose a new measure that is based on using a forward-looking expected returns and an aggregate green score. So we are very happy to have Lasse today, and I want also to extend my thanks to the two co-moderators of today's sessions, Professor Riccardo Rebonato, who is a professor of finance and senior advisor of EDHEC Climate Institute, and one of our bright students from our MSc in Climate Change and Sustainable Finance, Théo, Jesover. So without further ado, Lasse, the screen is yours.
Thanks a lot for this introduction, and thanks a lot for inviting me to your series. So let me share my screen here. So hopefully you can see it.
Yeah, perfect.
And so this is a joint paper with Mark Eskilsson, Markus Ebert, and my former student Thijs Jensen, who's now at Yale. So the research question here is, how big is the so-called greenium? And so let me actually start by defining the greenium. The greenium is the expected return of green stocks or green securities over and above the expected return on brown securities. So in other words, for instance, with a stock, are you making more money if you invest in green stocks versus polluting stocks of polluting firms? So from the investor's perspective, this is obviously an important and useful number to know, because some people will say, actually, the greenium is a positive number, meaning that green stocks outperform brown stocks. And so such investors might be saying, I'm doing well by doing good. In other words, I'm making money, and at the same time, I'm doing good for the world by supporting, in some sense, the green and clean technologies. Other people say, no, actually, if a lot of people are buying green stocks just because they're green, not because they're necessarily good investments, then those stocks become potentially more expensive or overvalued, some people might say. And if you buy something that's overvalued, then on a going forward basis, it's going to deliver a lower return. And so based on that view, and a view that is consistent with some papers that have developed an ESG, environmental, social, and governance version of the capital asset pricing model, an ESG CAPM. So according to the ESG CAPM, you might expect the greenium to be negative, again, because if some investors are willing to buy the green stocks for other reasons, then it's natural that those stocks become more expensive and therefore deliver lower average returns. Now, from a firm's perspective, the greenium is also important, but the firm's perspective is a little bit different, because the firms might be thinking about their cost of capital. So the cost of capital could be, for instance, if they go to the bank, what interest will the bank charge them? Will they charge a different interest rate for green firms versus brown firms? For instance, if the regulators are trying to push banks to make more green loans, then the banks might be willing to give a green loan at a lower interest rate. And so it's going to therefore be easier to make green investments because your financing costs will be lower. Or if you think in terms of your NPV, if you have a lower financing cost, then for the same cash flows, the NPV will be higher for green projects. But you can use the same thinking for corporate bonds or equities. If the cost of capital is lower for green securities than or green firms, then you might expect more green investment in those types of firms. So from the firm's perspective, the greenium is really about, is the cost of capital lower for green firms versus brown firms? And if we put those two perspectives together, I think it becomes clear that if you are an environmental investor, it's not a mistake to invest in green stocks, even if you believe they have a lower return. In other words, you could say, I'm willing to accept a lower return because the flip side of that low return on green investments is that the green firms have a lower cost of capital, and I'm fine with supporting those kinds of firms. Now, the third perspective is, does it really matter in the end? Does the world become a greener place because of these types of investments? And so I actually have another paper where I dig more into that from a theoretical perspective. And actually, the paper I'll focus on today is, you can think of it as, in some sense, the empirical counterpart. So I'll try to bring those two together so we can see in the end whether this actually makes the world a greener place or not. So the focus here is really the empirical perspective. What is the greenium? Is it positive or negative? Do you make more money? Do you lose money? What is the cost of capital for firms? And since this is clearly a big question for investors, for firms, for regulators, there's been a ton of research on this. The research is mainly focused on US stocks, and it's mainly focused on realized returns. So what has been the historical stock return of green stocks versus brown stocks? And the evidence is actually shockingly mixed. There are many different data providers that have different opinions about what makes a stock green or brown. And the different papers use different time periods, and they reach very different conclusions. So one recent paper says that green stocks underperform brown stocks by 440 basis points per year. So in other words, that's 4% per year. So that's a big underperformance. Another paper says that no, green stocks outperform the brown stocks by 780 basis points per year, so almost 8% per year. So the opposite sign. So one says the green stocks underperform, the other says green stocks outperform. And again, there are many, many papers on this, but they all reach quite different conclusions. Even though, by the way, these papers have the opposite results on realized returns, they both conclude that going forward, green stocks will underperform, that the greenium is negative, because I think most academics believe that is the correct answer. Now, how can they use the opposite evidence to reach the same conclusion? Well, the first paper says green stocks have always underperformed, and therefore they will continue to always underperform. The second paper says green stocks used to be priced the same as brown stocks. Then they became more expensive, and in the process of becoming expensive, they outperformed. But now that they are expensive, they will underperform going forward. So actually, they reached the opposite conclusion based on different ways of thinking about the repricing that might have occurred over this time period. So what we do in the paper is we try to make sense of this relatively confused literature. So we have two parts. One where we try to replicate the whole literature. So we take all the measures of what it means to be green from the literature, and we are not just looking in the US, but we're also looking in 48 different countries. And what we find, and I'll show you more details, is that globally, green minus brown stock returns have really varied depending on how you measure it, but they've been centered around 0. And when you take into account that you're doing many tests, when you can do this in many ways, all these tests actually become insignificant. So in other words, using realized returns over typically around 10, 15 years, we can't really know the answer. It's just too noisy. It's too short of a time series, and this issue of repricing also makes the task extra difficult. The second part of the paper is trying to search for the true greenium in a different way. And so we look at both an asset pricing theory that tries to handle that there are many ways to estimate what it means to be green. And I won't focus on that so much today, but based on this theory, we say what might be better is to, first of all, find the green score that most investors are looking at. So we have a way of looking at that from investors' portfolio holdings. And then second of all, trying to look at a forward-looking expected return measure. And just to give you some intuition for that, suppose you're looking at an investor, you go to the bank and you say, I'm green. And the bank says, okay, you're green. I give you a loan. The interest rate is 10%. And then another firm goes to the bank and says, actually, I want to, have a very brown project. The bank says, okay, you have the same risk, but in any case, I'll give you an interest rate of 14%. In that case, we would know pretty accurately, well, if the green gets 10% and the other guy gets 14%, the spread would be a 4 percentage point greenium. Or in other words, in this case, since the green got the lower interest rate, it would be minus 4% greenium. So that's an interest rate, that's sort of a forward-looking over the life of the loan. This is what I'm paying. You can do the same with the corporate bond. It has a bond yield. Now, a corporate bond also has a bond return, which is much more noisy. So the lesson here is that yields are more stable than returns. For equities, we don't have such a simple measure as an interest rate, but there's something similar called implied cost of capital, and that's what we're going to look at, as well as other measures. And what we find then is that the greenium, by our estimate, is minus 39 basis point per year and per standard deviation difference in the green score. And since if we're looking at, again, green minus brown, the expected return of green stocks versus brown stocks, the typical green portfolio is about 1 standard deviation greener than the average stock, and the brown portfolio is 1 standard deviation more brown than the average stock. So the green minus brown portfolio is a 2 standard deviation spread. So we find that the expected return on that portfolio or our sample is about minus 82 basis points. So in other words, about minus 1%. So if you started out investing in only brown stocks and you disinvested from that portfolio and only invested now in only green stocks, then your return would be lowered by about 1% per year based on our estimate. So that's the magnitude. It's larger in greener countries like France or Denmark. It's larger recently. And we also look at it in corporate bonds and the weighted average cost of capital. And it's also a little bit smaller in magnitude. And then the question is that enough to address things like global warming? And let me postpone the answer to that until I get a little further in my presentation. But that's the highlights, so I'll show you some of the details of how we reach these conclusions. And I'll make sure to leave some time for questions. So let me start with this first part where we look at what's happening in the literature. So in the literature, much of the academic literature is about US stocks. Obviously, the US has very good data, has a big stock market, but there are other important countries too. And so where we try to look at, rather than just looking at the US, we also look at stocks in other countries, in 48 other countries, in fact. In the literature, they typically look at one measure of greenness per paper. We try to look at all of them together. They try to have, different papers have different sample periods depending on when they come out. We try to extend all of them to the most recent data. Some papers use one kind of risk adjustment. Other papers use another risk adjustment. For every measure of greenness, we use all combinations of risk adjustments. And given that we are considering all these ways of measuring what it means to be green, all these ways of adjusting for risk, we can also adjust for the fact that we are making many tests, because if you're testing hundreds of different combinations of the return of green minus brown, you might find significance just by chance. And so here's a list of many of the measures we look at. let me not go through all of them, but let me just say that we have some measures of total emissions that some papers look at. Total emission is a little bit of a strange measure in the sense that, of course, bigger firms will have a larger total emissions, so it'll be very correlated with the size of the firm. I think it's more reasonable to look at emission intensity, which a bunch of other papers look at here, where you can see that, for instance, S1 in sales, that means you take the scope 1 emissions, so the direct emission that firm makes, and then you divide that by the sales of the firm. We also look at things like S1 in assets. That means the scope 1, the direct emissions, divided by the assets of the firm. We also look at S1 plus 2. That means scope 1 plus scope 2. So that includes the indirect emissions from electricity consumption. And we also look at scope 1 plus scope 2 plus scope 3, which is what other papers are using. We're also looking at different ESG score, environmental scores from MSCI and Sustainalytics. And we also have some other data from the Environmental Protection Agency. So those are the kinds of measures we look at. Then for every measure, what we do is we look at all the stocks at every month. We say, what are the greenest 1/3 of the stocks? We call that the green portfolio. We look at what is the dirtiest 1/3 of the stocks. We call that the brown portfolio. And then we ask, how much money do you make if you buy the green stocks by that measure and short the brown stocks? And we can do it actually in two ways, because the industry or the literature does it in two ways. You can say, I don't care about the industry of the stocks. I just go long the green stocks and short the brown stocks. And it could be that many of my long green stocks are in the same industry. That's fine. And many of the brown stocks are in the same industry. That's fine. Or another way to do it is sort of do it more best in class. So within every industry, you say, what's the greenest 1/3? What's the brownest 1/3? You go long, short in every industry. And then you diversify across industries. So we have, again, 23 measures of greenness. And then we can do it as what we call industry neutral or industry agnostic. So that generates 46 portfolios. Here I'm plotting it for the US, but we also do it, as I mentioned, in 48 other countries. And what we can see here is that the cumulative return from 2010 through recently, it's kind of a little bit all over the place, right? In some, by some measures of greenness, green has outperformed. So when this line goes up here, we can see that means that green has outperformed brown. If it ends down here, that means that green has underperformed. So we can already see that the results look very different. Also, some papers might start here and end there. So then it could look quite strong. Other papers might start here and end there and get other results. So it also depends on the sample. If we look at, so as you know, in academic research, we always want to look at the statistical significance. So if this return is positive, we want to know, does it look like it's positive just by chance, or is it statistically significant? That is, that it looks like it has gone up so much that it seems like it's not just by chance, that it's really statistically significant. And the way we measure that significance is by looking at something called a t-statistic. And normally we say if a t-statistic is bigger than 2, then it's not random, then it's real. Or if it's less than -2, then it's also, seems like it's significant. It's not just by chance, but it's gone into negative territory. If we look at this graph here, we are looking at the various t-statistics on the x-axis and how frequently we see significance. So if you look at first the blue paper distribution here, that's saying that the frequency of seeing t-stats of different sizes. So these here we see these are published papers, this blue, where they say it's statistically significantly positive. So in other words, here we see green has outperformed brown. That's like one of the papers I cited in the beginning. Down here we see the opposite. These are papers saying, no, actually green has statistically significantly underperformed. And then there are also papers in the literature that says, well, actually we can't really tell. It's too noisy to tell. If we look at the green instead, the green distribution here, then we see it looks quite different. So here, when we just do it all the ways without selecting what looks good, without trying to publish a paper saying this is significant, it actually looks like most of the ways you can do it, you find that it's insignificant. Most of the green tests are in this insignificant region. But there are ones that are up here, and there are a few down here. These actually look kind of strange, and these could be due to some biases that have been discovered. But when you do so many tests, you expect sometimes randomly to find some that look significant, or randomly find some that look significantly negative. But when we take into account that that could happen by chance, then we conclude that it's actually all insignificant. So really, the conclusion is you cannot really learn much from these realized returns. And if the green is sort of the true distribution, it could be that some researchers happen to find this way of doing it, and then they led to this publication here. So there's something called publication bias, where we might more often see in the literature things that are significant, even if there are many ways in here to do it that wouldn't lead you to that conclusion. So that's not necessarily to say that the greenium is zero. It's just that these methods are not powerful enough to detect what it is. And we also do a little calculation in the paper saying, based on realized returns, how many years of data might you need to really estimate it with a strong significance? And we think it's around 167 years. So no wonder we don't see much in the sample that tends to be 10, 15 years. So there's just too little data with these realized returns, again, because, you know, stock prices just go up and down for many other reasons, whether than just that they're green or brown. There's just a lot of shocks to the firms. Maybe a factory burns down, so that's why there's a lot of noise in the data. So what we do instead is try to find another way to estimate the greenium. So we make two changes. One, I think, is probably the more important one, is that we look at these forward-looking expected returns. And specifically, we look at actually many different ones in the paper. The ones I'll focus on in today's talk is what's called the implied cost of capital. So again, the idea is to have something that's similar to an interest rate that you might get from the bank, or the yield you might get when you issue a bond, or the yield the firm is paying when they issue a bond, or the cost of capital that they effectively have to pay to their shareholders. So in this case, for equities, the way implied cost of capital is computed is you look at the stock price, and then you look at the expected future earnings of the firm, and then you compute the internal rate of return that is consistent with the current stock price and the current earnings expectations. So that's why it's similar to a yield. And again, the benefit of that, it's much more stable over time. And the repricing doesn't create this bias. If a stock is becoming repriced, the stock price is going up, then the implied cost of capital will go down over time, but it won't. We won't have this big bias coming from a repricing. And then second, rather than looking at all the different green scores separately, we do that too, by the way. We can look at them separately, but our main test focuses on what we call an aggregate green score, which is a way of basically looking at all the sustainable investors in the world. What are the stocks they overweight? And so, but that's sort of by revealed preference. Those are the stocks that they view as being green. And so those stocks we call having a high aggregate green score. And when we look at it this way, then what we do is we take and run a regression where on the left-hand side, we have this forward-looking expected return of every stock at each time. And then we regress it on how green that stock is. And the regression coefficient is then the greenium. In other words, the regression coefficient says, if I have a stock that's a little bit greener, how does the cost of capital or expected return change for that stock? And the result is, if we look at the global sample over the full time period from 2010 through today, in all countries in the world, that we find this negative 39 basis point here. Okay, so it's negative because green stocks that have higher green scores, so greener stocks, they have lower expected returns. They are more expensive, and therefore, on a going forward basis, we expect them to deliver a lower return. So we have, just note here, the scale has sort of inverted, has negative numbers going up this way. And so 0 here, and then the numbers goes up, and then measured again in basis points per year. If you look at brown countries, the effect is a little bit lower. In greener countries, the effect is a little bit bigger. If we look at the beginning of sample, there's basically no effect because investors didn't seem to care so much about greenness in 2000. At the end of the sample, the effect is stronger. If you look at corporate bonds and the weighted average cost of capital, the effect is a little bit smaller. We can also look at it visually here, where we have time on the x-axis, and then we have this greenium on the y-axis. We see in the beginning of the sample, it's slightly negative, but not really significant. And then over time, we can see that the greenium becomes more and more negative as sustainable investing becomes a bigger and bigger deal. And I'm looking forward to updating the data. It'll be interesting to see, what has happened here in the late sample, where some investors might have perhaps changed their preferences in light of the Ukraine war or other events. We can also look at it globally and try to estimate in every country. We can see here that the more dark green is the color, the more negative is the greenium. So the more investors seem to value green stocks, and we see in the Nordics, in France, that greenness seems to be quite important. Also in Australia, they seem to have a strong preference for green stocks. And then finally, if we look at individual green scores, again, remember I mentioned we have total emissions, carbon intensity, ESG measures, E measures, and so on. We see that the strongest greenium here is so we have on the x-axis, we have the correlation to this aggregate green score. And of course, the aggregate green score itself has a correlation of 1 with itself. And the aggregate green score has the most negative greenium. And then if you look at all the other individual measures, they all tend to be negative. But the more they line up with investor positions, the more negative they are. And one of the interesting ones is carbon emissions. So CO2 over assets turns out to be a particularly important one, which is one of the ones here. So if you really care about climate change, I would argue that you should, as an investor, care about this green score, CO2 over assets. But that's only 0.2 correlated with what investors seem to care about the most. So investors are investing based on lots of different measures. They're not particularly focused on CO2. So the pricing of CO2 is much smaller than it could be if investors had chosen to focus on that. So that brings me...
Lasse, if I may,
Sure.
what are the ones that are closer to the aggregate one? That means you mentioned the CO2 assets, but there are some on the top right. Could you explain a bit what they correspond to, just to understand what the investor care more about?
So those are MSCI ESG scores, I believe. So I think a lot of investors are buying an aggregate MSCI ESG score for MSCI is I think the market leader, but there are others, Sustainalytics, many others, and they take an average of many things, and just like the EU regulation has more than 1,100 items in this sustainable disclosure regulation that they encourage firms to disclose, which I think is problematic, because when you disclose so many things and ESG providers, then they take all these things and then they take maybe averages of things that are super important, like your CO2 emission, and then something that's relatively unimportant. And if they take simple averages, then firms also don't really have such a strong incentive to cut down on emission if that's costly, but they can play with some other number that affects the overall average just as much.
Thank you.
But of course, there are other environmental issues and important issues other than carbon emissions. But yeah, but it's hard. It's also not so transparent exactly how all these measures are computed. All right. So then that brings me to the final part of the presentation. So what we've seen so far is that the greenium appears to be negative. So that means that green stocks are more expensive, and therefore the expected return going forward on investing in green stock is slightly lower, not a huge amount, but slightly lower. And on the flip side, the cost of capital for green firms is slightly lower. So that's the right sign if you want to save the world. If you want to fix global warming, then you want that the clean technologies can finance themselves more cheaply. But of course, the question is it big enough? So another way to say it is, the typical solution in economics is, if you have an externality, if you're polluting, then you should have a tax. There should be a carbon tax. I think almost all economists agree on that. And the carbon tax, should equal the social cost. So then the more difficult question is, what should be the carbon tax? And Nordhaus, he won the Nobel Prize, not for saying that we should have a carbon tax. I think most economists knew that already, but to saying what the number should be. So, and he said it should be at least $43 per metric ton now, or 43 euros per metric ton, but probably should be much higher, maybe should be 200 or 300, but that's sort of the ballpark. Let's say between 43 and 300, just to say. It shouldn't be €1 per ton. It shouldn't be 10,000 euros per ton right now, but it should be in that ballpark. Still, we don't know it exactly, but I think at least you won the Nobel Prize for saying that's the right ballpark. So what about in the weird thing a little bit in sustainable finance, people haven't really thought about the magnitude. They just said, green is good, green should have a lower cost of capital, but how much? That's certainly an important question. We can't just say we should have a carbon tax. Well, should it be? What should be the price or the level? And so we want to know the same there. And so in this related recent paper I have, it's called Carbon Pricing versus Green Finance, I basically say, I don't know what exactly the right cost of capital should be, and I don't even know what the right carbon tax is. But suppose I just say I believe Nordhaus. Suppose I say that I believe that the carbon tax should be 43. And now I'm doing a more modest exercise than Nordhaus. I'm just saying, if I believe him, what cost of capital has the same effect as a carbon tax of 43? In other words, if firms have to pay $43 every time they pollute, that's costly for them. But suppose they're not paying it. Instead, they're paying a higher cost of capital for polluting. And maybe I show in the paper that you can actually achieve the same effect either way under certain conditions. And the way you can achieve the same effect is that the cost of capital, so here's COC, that means cost of capital. That should be the quote unquote sort of baseline cost of capital in a world without sustainable finance. So let's call it 5%, just as an example. Plus, here what we have is the desired carbon tax minus the actual. So suppose there is no carbon tax. So this is 0. And then Nordhaus says there really should have been a carbon tax of $43. So we put 43 here. So 43 minus 0 is 43. And that should then multiply every firm's emission time divided by the firm value. Okay, so why should it multiply by emission? Well, Nordhaus says your tax should be 43 times your emission, right? That's your total tax bill. But the tax bill doesn't translate one-to-one to cost of capital. I show in the paper that to make it into a percentage number, a cost of capital number, you have to divide by firm value. Okay, and just to be very practical about it, so suppose now here again we say cost of capital should be 5% plus $43 times emissions times firm value, and then plug in for every. These are observable things for many firms. I know their emissions. I get the data on the emissions. I know the firm values, and then I look for different industries. For instance, dirty electricity. I see that their cost of capital should be, you can see here, more than 8%, so more than 3 percentage points elevated relative to this baseline. And other utilities here, you see, these are the dirty industries. You have the more clean industries in here. Okay, so this is how much we should have. Now, how do we take an empirical version of this? The empirical version is we have these expected implied cost of capital. We regress it across firms on their emission divided by firm value. And in this paper that I've been focusing on, In Search of the True Greenium, we run this regression. We get a regression coefficient of 4. So that means that in the data, it looks like, yes, dirtier firms have a higher cost of capital. But this green line here, that's the regression line. That's saying basically that, yes, dirtier firms have a slightly higher cost of capital, but not nearly enough. It should be that if I'm a firm and I put myself out here, I'm very dirty, I have a high cost of capital, I get punished with a high cost of capital, yes, but not nearly enough. I should be punished with such a high cost of capital. I'm in reality only be punished by that. And remember, Nordhaus is actually saying probably it should be 200 or 300. So then this line would be way, way steeper, and the cost of capital would be way, way higher. So this is certainly, saying that the cost of capital that we see in the data. So the 4, by the way, means also that it's similar to having a carbon tax of $4. So it's sort of not if you look globally, the carbon tax is a little bit higher than that or on average, but not much more. So it's saying that currently sustainable investing is probably doing a similar amount of good in the world as the global carbon tax. But in countries like Europe, it's really kind of a trivial effect. And it's, given the regulatory burden, maybe it's not really worth that big regulatory burden that's hampering the growth in Europe. So in conclusion, I want to end with plenty of time for questions, but the greenium is a central question on the magnitude of the greenium. It's central to ESG investors, to regulators, to firms. It seems like the greenium is negative. It's not completely trivial in size, but it's not enough to really drive the green transition as it is. If we look across different firms, different industries, we can see that the impact on the cost of capital is in the order of basis points or perhaps percent, about 1%. But to really have a green transition, we would need a much bigger effect. So with that, let me open it up for question, and perhaps I should stop sharing the screen.
Thank you very much, Lasse. Great talk. So now I'll pass over to Professor Riccardo Rebonato.
Thank you so much. Really, really interesting talk and super interesting results. Can you help me with starting from step 1, from the very beginning? So we are talking about risk premium, and we're looking at the risk premium of the greens and risk premium of the brown. And for the moment, let's suppose that we can all agree what is green and what is brown, which is not obvious, but let's keep things simple. If I think about a risk premium, and let's suppose that these things are priced according to rational asset pricing. So investors are rational and they behave as in the finance textbooks. So a risk premium should be a covariance between the payoff of the firm and consumption growth, or let's say how well the economy is doing. And here comes my question. At the moment, there are two things. If we look at all the scenarios like NGFS and IPCC, etc., typically they have a fixed projection of economic growth, and therefore climate damages, almost by construction, create a reduction in economic output. So there is a negative correlation between economic output and damages. But if you do a dynamic simulation with a dice-like model, you mentioned Nordhaus, and you can enrich it in many ways, we always find, and we make things stochastic, we find the opposite, that high emissions, high temperature, high concentration, high damages occur in states of high consumption. So to begin with, how does this relate to this risk premium of brown and green stocks? And how do we define green and brown stock? Does a green stock do well when the economy is doing well or when the economy is doing badly? Because to me, that seems like the fundamental question.
Yeah, no, that is a very good question and an advanced one. I hope all your students understand and follow. But let me actually back up. And you're absolutely right, everything you say. But the greenium, the expected return of green versus brown, actually can be driven by two effects. There could be the risk premium that you're talking about, and I'll come back to that. But then there's actually a big literature that assumes it's not driven by a risk premium, that it's driven by preferences in the following sense, that if some investors are saying, even for the same risk, I'm willing to buy the green just out of the goodness of my heart,
yeah,
then I'm willing to accept perhaps a lower return or persuade myself that they'll get a higher return, even though maybe it's not true. Then those investors will push up the price. The other investors, they might then undo the effect by changing their portfolios, but they might not completely undo the effect. And therefore, green stocks become expensive, not even unrelated to risk. And I think that's the mechanism many of these papers have in mind, including some of my own work. But actually, to your point, I'm actually working on a new paper that tries to think about the risk premium. So and just so for the benefit of the audience, so the second reason that green stocks could be more expensive is that they are somehow safer. And what you hear, the argument that you hear from regulators actually quite a bit, is that because also from a lot of pension funds perspective, many pension funds in Europe, they want to buy green because that's seems like the morally right thing. But then if they say, by the way, if I buy green, I do it out of the goodness of my heart, even though I get a low return. Many of them, they're not allowed to say this.
Yep.
Because they have a fiduciary duty to make high returns. And they don't. So they say, maybe I make lower return, that's okay, but I also have lower risk. So I'm still maximizing risk-adjusted return. So there's a lot of people who want to claim that green is safer. And the argument goes like this, I think, that there is a big risk or that carbon taxes will go up. If carbon taxes go up, then that will hurt the brown firms and it will hurt less or not hurt the green firms. So the green firms will outperform the brown in that scenario. Now, that argument is actually either wrong or incomplete because you said it right, and I'm just paraphrasing. So the problem with the one I'm paraphrasing is that risk is always two-sided. If carbon taxes maybe can go up more than we expect, then yes, green will do well. But carbon taxes can also go up less than we expect or even go down. And then if carbon tax, let's say, go down, then brown stocks will do well and green stocks will do relatively less well. So if we talk about risk, as you said it exactly right. The question is, where's the marginal utility higher?
Yeah.
Is the scary scenario carbon taxes go up or carbon taxes go down? And as you actually correctly pointed out, it's quite complicated, and we show this in a model, is that if we imagine a scenario where, let's say, carbon taxes suddenly go up, what you would expect from many of these models is that in the near term, consumption will go down a little bit, right? Because then if you increase carbon tax, you force the economy to change, to become greener, and every change is always difficult. But in the long run, it will actually lead to higher consumption, because if you don't have a carbon tax, you destroy the world, and then eventually it's going to lead to lower consumption. So you have two effects. High carbon tax is low near-term consumption, high consumption growth. But here's the punchline on the risk. Right now, most people would agree the carbon tax globally is way too low. It's lower than what will maximize utility. If it then goes up, then it goes in the right direction. Then we should all be happy that it goes up on total. So this is not a scary scenario. The scary scenario should be, if you're rational, carbon tax goes down, you destroy the world. So therefore, the risky stocks in an asset pricing sense is the one that loses money in the scary scenario. The scary scenario is carbon tax goes down. When the carbon tax goes down, the green stocks lose. So green stocks are risky.
I see your reasoning. I don't want to get too technical.
And brown stocks are safe.
The timing of the losses and the gains are very different.
Yeah.
And at that point, it's also the state-dependent discounting. In what state how do I discount the losses? Are they losses in high consumption? But it's thank you. Very, very, very nice, very clear.
Great discussion. Riccardo, do you have any other question you want to ask before we?
Why don't I give
okay,
the floor to
Théo?
and if I have any other question, I don't want to monopolize, because I could keep asking questions for a couple of hours.
For sure, we can continue after.
I wouldn't be very popular. Yes.
Thank you, Professor, for the presentation. It was extremely clear. I had two quick quantitative questions and then one qualitative. The first two quantitative is, what controls do you have in your regression? I assume you have geographic and all that, but I was curious of the others. And the second is for the firm value in your cost of capital. Is it market or book firm value? You take into account for.
So for the cost of capital computation, it's the market value.
Okay.
And in terms of the risk controls, we control for the market beta, for the size and profitability of the firm, and the leverage.
Okay, got it. And so, like in the graph where you see the correlation between the green scores and the greenium, you seem to be saying that basically the market is using the wrong green scores with like with the ESG MSCI instead of like CO2 over assets. So would you recommend investors in general, like professionals, to use more of that CO2 over assets? Is it mispriced? Is the market mispricing the green scores? That'd be my last question.
I think maybe it's I put it too strongly. I said, if you want to address climate change and that's your only concern, then I think you should look at CO2 or assets. Or some people call it your carbon footprint. It's sort of equivalent. You should look at the carbon footprint of your portfolio. But, the issue is that investors are, you know, mainly I think concerned with their risk and expected return, but they also have different separate considerations. And you know, those are preference to the extent those are preferences. I'm not one to judge their preferences. I think you know, those preferences have changed, and I think it's important to remember that you know that you should not just put too many things into your ESG score, and it should be things that are not already addressed by other regulation. I think that's one of the big misunderstandings, actually. If you look at my formula, I don't know if you remember, but I have this, there's the desired tax minus the actual tax. Okay, so if you say, I think the carbon tax should be 100, and in fact it is 100, then now you shouldn't also change your portfolio. Firms are already paying a carbon tax. You shouldn't change your portfolio as well. I think it's what we see often is that Europe is trying to have a carbon tax and all kinds of sustainable finance regulation. So why is Europe necessarily doing both? I'm not sure that makes sense. Whereas then other countries are doing neither. So to the extent, for instance, that European investors should punish polluting firms, they should more, in some sense, punish polluting firms outside of Europe, because the ones inside of Europe are already paying a tax, many of them.
Yeah. Well, that's CBAM, I guess, but yeah. Thank you.
Okay, Théo. Okay, thank you very much. So there are a couple of there are 2 questions in the Q&A, but I just want, before Lars, could you explain a bit, if possible, how you construct your aggregate score? Because this is something that I guess is important in your paper, and if I understand well, there is a way to proxy it with respect to the holdings of the investor. So if you can just explain a bit how you measure this aggregate score, green score.
Yeah. So it's something actually that has changed a little bit over time as we've been working on the paper. So in the first draft of the paper, which is you know, still something we're trying to improve in different directions, but in the first draft we took across all the measures the one we thought were reasonable and took an equal weighted average of those, and the results were actually not too dissimilar from what I showed you. But then as we were thinking about it more and got comments from referees and so on, we thought, let's try to be more rigorous about it. So then we actually got data from Morningstar on all global sustainable investment funds and their portfolio holdings. And then, you know, there are several things we can do. One is to try to regress those portfolio holdings on the different ESG scores that we got from the different data providers, and see which scores are most powerful in explaining actual portfolio holdings. So one way we have also done our results is to take a weighted average of all the ESG scores from the literature, weighted by the extent to which investors appear to be using them. But then we also create our own score that is not actually a weighted average of the ESG provider scores and the true cost numbers, but instead we are simply saying the stock that is the most, that sustainable investor seems to be the most invested in terms of the fraction of shares that they own, is apparently the one they consider greenest or most sustainable, and so on. And then we rank stocks based on where the sustainable investors own the largest fraction.
Thank you very much. So several questions. One from Adin. Wouldn't an overall consumption tax be better than the carbon tax? This would lead to a real reduction in wasteful consumption, including but not limited to carbon use. Private households consume 70% of GDP, particularly wealthy households. So the question is with respect to the tax, consumption versus carbon tax.
Sorry, I didn't completely hear the question. So it's a carbon tax versus
a consumption tax.
So consumption tax unrelated to carbon emissions?
Yeah.
Yeah, I guess must be related to it, right? But here he assumed that the consumption leads to carbon emission.
Yeah. So a carbon tax, the way it's implemented now, only affects certain industries in certain countries. But the carbon tax that Nordhaus would recommend is one that includes all emissions. So if you have a gasoline-driven car, you're actually burning fossil fuels as you're driving. So you should be paying a carbon tax, and you can, for instance, charge that as part of the gasoline when you buy the gas. Then you should pay a carbon tax. So in that sense, I think I would agree that everybody should pay a carbon tax, not just firms, but also individuals. But it shouldn't just be consumption per se. It should certainly be consumption that leads to emissions.
Thank you. Another
Can I
question
ask
from
a question, Emmanuel? Can I come in
sure.
with a question?
Please.
In your formula, there was desired tax minus actual tax.
Right.
When you have, I think that, for example, you put actual tax close to zero. Have you considered the case that there are actual fossil fuel subsidies? And if we look globally, these fossil fuel subsidies are substantial. And so it could be that depending on how you calculate, some people put in the externalities, some people don't, the actual tax is negative.
Yeah, that's a great point. So then the
Then
formula
it's even
still
worse.
works. The formula still works, but as you say, then you could have a scenario where you would want to raise the cost of capital, more than the social cost of carbon to first of all penalize the social cost that you have, but also undo the subsidy.
Yeah, yeah.
Yeah, you're exactly right.
No, I found your formula really, really nice because you can really plug in. If you look at the meta studies done by Richard Toll of the social cost of carbon recommended by many economists, Nordhaus is a very low end. And if you do the median is almost double. And therefore,
Double the 43 or the
it's the median I've calculated being around 75.
yeah.
At that point, your point becomes even stronger.
Yeah,
Because the
definitely.
desired tax is even bigger, so your top line goes even steeper,
Yeah,
and the divergence with the actual line at the bottom is even more startling.
exactly.
So I think it's a very impressive graph. Yeah, I'm going to teach it to my students.
Oh, thank you.
Okay, so last question from the audience before we close this session from Sebastian. When computing the greenium on bonds, if you isolate the green effect within the spread components in a regression, including other spread components, how do you make sure there is no overfitting, especially when you see that in some papers the greenium is barely larger than the residuals? So there is
Yeah, I mean, that's certainly a fair point, and you can never be completely sure in empirical work. One of the things we do differently from other papers, that many other papers, they look at green bonds versus normal corporate bonds. But we are actually looking at standard corporate bonds because the green bonds are still a fairly small part of the corporate bond sector. So we try to have a large sample by looking at standard corporate bond issued by green firms versus standard corporate bond issued by brown firms to have a bigger sample. And then we also try to limit the number of control variables, but it's certainly a fair point. We also did look at green bonds in some countries, the government, like in Denmark and Germany, the government will issue completely identical bonds, same coupon, same maturity. One is green, the other is not green, and they actually have slightly different yields. So that's a very, very unequivocal, precise estimate of the greenium. But in those cases where it's so accurate, it's actually only a few basis points. So in Denmark, might be 3 or 4 basis points difference for a green government bond versus a standard government bond.
Does it show the preferences or does it show the power of arbitrageurs?
I think it shows that that preferences are not zero, but how strong they are, we don't know. But certainly, I think it's also the power of arbitrageurs to make that spread very tight.
Yeah. Yeah.
Okay, thank you very much. So thank you, Lasse. This was a great session. Thanks, Riccardo. Thanks, Théo. It's time
Thank you
to
very
wrap
much.
up. So just a reminder, we will be back Tuesday, October 28th for the continue on the future of finance with Professor Rusla Goyenko, and we will talk about another topic, but as interesting, about trading volume alpha. So thank you, Lasse. This was a really, really very stimulating session. Thank you again.
Yeah, thanks a lot.
Merci
Thank you.
beaucoup.